As of this exact moment on Wednesday, December 17th, 2025, NVIDIA Corp is trading live at $173.88, down $3.84, which represents a decline of approximately 2.16% for the intraday session. While the headline number flashing red on your screen might trigger an immediate emotional response or a sudden urge to check your portfolio balance, what is happening beneath the surface of this price action is far more significant than a simple daily fluctuation. Most market participants are looking at this drop and attributing it entirely to the recent profit-taking waves we've seen ripple through the semiconductor sector, assuming this is just another standard correction in a long-term uptrend. However, the reality is that we are witnessing a fundamental decoupling event where the smart money is aggressively testing the conviction of retail holders before the next major liquidity cycle begins. You might see a red arrow, but institutional algorithms are seeing a liquidity flush that they've been waiting weeks to execute. This is not just selling, this is a calculated stress test of the $175 support zone, and understanding the mechanics of this move is critical for anyone holding the stock today. When you look at the broader market context, the tension between what investors expect and what is actually unfolding is palpable. The expectation right now, fueled by recent headlines, is that the artificial intelligence infrastructure trade is getting crowded and that capital expenditure from big hyperscalers like Microsoft and Meta is bound to slow down. People see the red ticker and think the bubble is finally leaking, but the reality is that the order books for NVIDIA's Blackwell Ultra chips are not only full, they're effectively locked down well into 2026, and what we're seeing today is a disconnect between short-term sentiment and long-term industrial production. This decline is largely a reaction to the noise surrounding Oracle's recent earnings miss and Broadcom's margin warnings, which have spooked the weaker hands in the market. Investors are taking those data points and erroneously extrapolating them to NVIDIA, assuming that if Oracle is having trouble efficiently deploying capital, then NVIDIA must be facing a demand cliff. That logic is flawed, and it creates a massive inefficiency in the price that savvy investors can exploit. Let's talk about the specific mechanics driving this sell-off because it is crucial to separate the signal from the noise. The volume we're seeing today is slightly elevated, which tells us that there is active distribution occurring, likely from funds that are rebalancing their portfolios before the year closes. You have to remember that for many managers, locking in gains on a stock that has been a portfolio maker for the last 2 years is a career preservation move. They aren't selling because the fundamental thesis has broken, they're selling because they need to show realized gains to their limited partners. This is where the retail investor often gets caught on the wrong side of the trade. You might be logging into your Fidelity mobile app or checking your Schwab Intelligent Portfolios dashboard, seeing the drop and feeling the pressure to sell. But if you look closely at the order flow, the bid-ask spreads are remaining tight, which indicates that while there is selling pressure, there is also robust absorption by larger entities who are stepping in to accumulate shares at these discounted levels. This brings us to a critical point about how you execute your strategy in this environment. Whether you're using Robinhood stock trading for its ease of use or a more robust interactive brokers trading station with advanced charting, the psychological game remains the same. The market is designed to transfer wealth from the impatient to the patient. Right now, the narrative being spun is that competition is finally catching up. We're seeing headlines about Amazon reportedly discussing a massive $10 billion investment in OpenAI to push their own Trainium chips. This is the boogeyman story of the day, the idea that NVIDIA's biggest customers will eventually become its biggest competitors. While this is a valid long-term risk, the market's reaction today is essentially pricing in a worst-case scenario that is years away from materializing, if it ever does. The reality is that the software ecosystem NVIDIA has built with CUDA is so deeply entrenched that even if OpenAI or Amazon develops a decent alternative chip, the switching costs and the friction involved in migrating the entire AI development stack are astronomical. Think about the sheer scale of the infrastructure we're discussing here. We're talking about data centers that consume as much power as small cities. When you use SoFi Invest or Fidelity Wealth Management Services to allocate capital to this sector, you aren't just buying a chip company, you're buying the construction firm for the digital age. The drop we're seeing today to the $173 level is testing the psychological resolve of the market. It's interesting to note that this level coincides with a significant technical support band. If you look at the charts on your Fidelity trading platform or even the basic view on Robinhood Cash Management, you'll see that the stock has repeatedly found buyers in the low 170s. This is not a coincidence. Algorithmic trading bots are programmed to defend these levels because they represent the lower bound of the current consolidation channel. If the price were to break significantly below this, say into the 165 range, that would signal a breakdown in market structure. But as of right now, we're simply oscillating within a known range, flushing out the leverage before the next directional move. I want to pause here and ask you a question that really matters for your positioning. Comment below how many shares of NVIDIA you currently hold, and more importantly, what is your average cost basis? Are you sitting on gains from the pre-split era, or did you enter during the recent highs? Seeing where the community stands helps us all understand the potential for panic selling versus long-term holding. Now, let's widen the lens to the macroeconomic factors pressing down on the stock today. We cannot ignore the fact that the broader semiconductor index is under pressure. It's not just NVIDIA. AMD and other peers are also facing headwinds. This sector-wide weakness is often a signal of rotation. Money managers are moving capital out of high-beta technology names and parking it in defensive sectors or fixed income as they await clarity on the Federal Reserve's interest rate path for 2026. When you're engaged in online investing or looking for investment help, it's easy to get tunnel vision on a single ticker, but you have to respect the tide. If the tide is going out on the semi-sector, even the best ship will lower in the water. However, this rotation is usually temporary. The fundamental demand drivers for accelerated computing, generative AI, autonomous systems, and digital twins are secular trends that are not going away because of a few basis points in interest rates. Let's discuss the retail trading landscape for a moment because it influences the intraday volatility we're seeing today. Platforms like Robinhood App and SoFi Active Investing have democratized access to these markets, which is fantastic, but it also introduces a layer of emotional trading that wasn't as prevalent 20 years ago. When a stock like NVIDIA drops 2 or 3%, thousands of stop-loss orders triggered by retail traders on Robinhood Investments or Fidelity ETFs get hit simultaneously. This cascades the selling pressure, creating these sharp intraday dips that look terrifying but often lack institutional follow-through. If you're using Fidelity mutual funds or Fidelity IRAs for your long-term savings, these daily gyrations are statistically insignificant over a 10-year horizon. Yet the human brain is wired to react to immediate threats. The red color on your screen triggers a fight-or-flight response. The professional investor suppresses that instinct and looks at the data. The data says that NVIDIA's gross margins are still the envy of the hardware world, and their pricing power remains virtually unchecked despite the noise about competition. Speaking of competition, let's address the elephant in the room, China. The news that Chinese chipmaker MetaX has seen its stock surge nearly 700% in its IPO is adding fuel to the fire. It reinforces the narrative that China is rapidly building its own domestic supply chain to bypass U.S. export controls. While this is true, it is a development that will take years to mature. NVIDIA's lead in performance per watt and software optimization is not something that can be cloned overnight. When you compare Tesla stock or Apple stock to NVIDIA, you see different types of moats. Apple has a consumer brand moat. Tesla has a manufacturing and data moat. NVIDIA has a developer moat. Every student learning AI today is learning on NVIDIA hardware. Every major researcher is publishing papers based on NVIDIA architecture. That intellectual capture is incredibly difficult to break. So when you see Interactive Brokers' trading volumes spike on news of a Chinese competitor, recognize it for what it is, a headline-driven reaction, not a fundamental thesis buster. We also need to consider the role of self-investing tools and robo-advisors in today's market action. Many passive vehicles like Schwab Intelligent Portfolios or SoFi Robo-Advisor rebalance automatically. If NVIDIA's weight in an index gets